Welcome to our podcast series, Talking with Traders, hosted by expert trader Garth McKenzie in London, from where he's interviewing various guests on the topic of trading.
Welcome back to Season 7 of Talking with Traders. We're now into the fourth year of this podcast since it started in early 2020. Once again, IG have come on board as our sponsor for this season. We are truly privileged and grateful to have such a global leader in CFD trading as our sponsor. Over the coming weeks, I'll be interviewing various guests from around the globe on the topic of trading. Some will be follow-ups with past guests, and some will be new guests. The idea behind this podcast is that you get a variety of views from a broad spectrum of market professionals. None of what you hear in these episodes is intended to be financial advice, but it is intended to get you thinking about how you might be able to apply what you hear here into your own trading and investing. Please remember to subscribe to this podcast in your favorite podcast app. That way you'll be notified when new episodes are released. Once again, thank you to IG for funding and sponsoring this podcast into its fourth year. And thank you, listeners, for tuning in. Please enjoy Season 7 of Talking with Traders. This week's guest on Talking with Traders is Willie Delwiche from HiMount Research in Milwaukee in the USA. I've really been looking forward to chatting to you, Willie. I know in the email correspondence that we had before this podcast, you said you don't really consider yourself a trader. So I must just make that clear to the listeners right up front. But that's also fine. We don't only talk to traders on this podcast. We talk to investors. We talk to anything that's interesting to the general trading and investing community. So welcome to Talking with Traders first up, and looking forward to the chat. Can you just tell us a little bit about yourself, a little bit about your background, please, Willie?
Sure. Garth, thanks for having me on. Thanks for inviting me. And yeah, I am definitely not a trader. Never been accused of that. You look at the market all the time, and I mean that's been my professional career. I graduated from college, undergrad in '99. Started working at a local Milwaukee firm in November of '99. So I got to see the final run up of the NASDAQ tech bubble.
Yeah.
And then in the first, 7 years of my career, I saw the S&P 500 get cut in half twice and then double twice. And so really a rather dramatic introduction to what's now been a career of looking at the market, trying to help mostly financial advisors make sense of what's news and what's noise and what to do about it from an asset allocation perspective and from a kind of a tactical risk exposure perspective.
Okay, cool. And you've got a CFA and a CMT, right?
Yes, I do. So I had to. So I was working at the firm I was working at the time. The typical path was to get your CFA right after you started as a junior analyst. The CMT, still not as widely known as a CFA, was even less widely known then, particularly in an area like Milwaukee. And so after successfully doing the CFA, then I had the ability and the freedom to go and pursue the CMT.
Yeah, and it's quite interesting to have both because, I mean, I know historically there's been sort of this, you sit in one of two camps, either you're a fundamental guy or you're a technical guy, and, never the two shall cross. But that's kind of from the old age. It's becoming more and more common, certainly in my career, which I guess spans about the same length as your career. We're starting to see technicals come in and to be more and more appreciated and respected, I suppose. And I've not come across a lot of people that have both the CFA as well as the CMT, the Chartered Market Technician. But for you to have both of them, that's pretty good. They're both very widely respected qualifications.
Yeah, I think I like it because it, technicals get a bad rap from fundamental analysts. Technicians like to get on fundamental analysts as well. But there are benefits from both. And so finding that middle ground and acknowledging kind of that balance of what should happen versus what could happen and what it is happening. I think that's really, from a risk management perspective, It's about keeping your opportunities open and, gleaning what you can from one discipline, gleaning what you can from another discipline, and not being so close-minded and hostile to other people's ideas that you can't see where there's something good there.
Yeah, 100%. No, completely agree with that. So as mentioned, you said you don't consider yourself a trader and you look more at the broader picture, bigger picture view of the markets. I saw on your Twitter, I don't know, do we call it Twitter these days? I think it's X.
Yeah,
so
you saw an X I posted?
You posted on X. We still like to call it a tweet, I guess. You posted a tweet. Yeah. I mean, that's just like a verb. But I'm surprised that they've done away with the brand. In any case, let's not get distracted. But the tweet that you posted was great. It said, over-explaining every day-to-day swing in the market produces a tale told by an idiot, full of sound and fury, signifying nothing. Don't forget to zoom out for perspective. Now, I really liked that. I thought that it captured it really, really, really well, because quite right. I find it with my own trading. If you get too close to the screens, you sit too close to the market, you kind of lose perspective. It's like you can't see the wood for the trees. So I guess you and I are similar in that respect. I've actually often found I tend to produce better results when I'm actually not quite so obsessed with the screens. Don't know if that's been your experience as well then.
Oh, there's two sides to that. One, stepping away from our screens, and it's super easy to be chained to them much more than we need to be. Thinking that we can only think if we're actually looking at something. I think, get out, go for a walk, go spend some time in the garden, whatever it is that you like to do as a hobby. I think that helps kind of facilitate some thinking related to the market. The other point, though, is that quote from Shakespeare is that we get so wrapped up in the stories that we're telling that they become meaningless. And the more we spend time polishing that story and focusing just on that story, the more we close our minds to other things that might be happening. So it's really this idea that if we're going to keep perspective, it means not listening to ourselves, but getting out in the world and listening to the market and being open to new ideas as they come along.
Yeah, absolutely. All right, so I want to chat to you a bit about where we are currently in the markets at this point in time. I know with a lot of these podcasts, we do try and keep the content somewhat evergreen. And on this, we'll talk about a little bit of evergreen stuff as well. But it's also useful sometimes to, when I have the opportunity to talk to somebody like yourself, who I really respect and whose analysis I really respect, it's quite appealing to get a bit of a current market view. So, from my perspective, and I guess I've seen it in some of your work as well, I mean, it feels like we're in a very tricky stage of the markets right now. We've got possibly a peak in interest rates. We've got very inverted yield curve, which is starting to steepen. And historically, that's been a precursor to recession. So there's a possibility of recession coming maybe next year sometime. Consumer savings look like they've been depleted from a lot of metrics that I follow. So what is your perspective on where we are in the market now? I've gotten the feeling that you're a little bit more cautious than a lot of other guys out there in the market who've been calling for a year-end rally and it's bullish. I kind of get the sense that you've been tempering that, but I mean, I don't want to put words in your mouth. So tell us from your perspective how you are viewing the market at this point in time, if you're looking at it on a, 12 to 18 month view.
Yeah. So I think when we do zoom out from the day-to-day of what's happening, a couple things stand out to me. One, it starts with interest rates. We have a generation of investors who know only the pattern of lower highs and lower lows when it comes to interest rates. And now that's been broken. So we need to acknowledge that interest rate regime, whether we're heading towards a short-term peak or not, something has changed with respect to the interest rate regime versus what we saw over the past 10 years, past 20 years, past 50 years. So we need to acknowledge that. And I think not focus on the fact that could we get a peak in yields? Maybe, but we're in a different trend environment, a different regime environment for yields. That's not just a 1 or 2 year type environment. This is probably something that's going to persist. Yields were picking up a little bit prior to COVID. Inflation was accelerating prior to COVID. And so then that brings us to, so we have this higher interest rate environment. Then what does that mean for stocks? And you look at how investors are positioned, not positioned for a year-end rally, but positioned from an asset allocation perspective. And you have way more exposure to equities than you historically have. So equity exposure is super high, fixed income exposure is historically low. I think there's an opportunity to rebalance that, probably not this year, but over the next 2, 5, 10 years. I think that's the bigger picture that we need to focus on, that shift in interest rates and the possibility that we're in one of these environments that we have seen in the past where stocks are volatile, but at the end of a decade, they're no higher than they were 10 years ago.
Yeah, it's interesting. I mean, I've seen a lot of other very respected market analysts suggesting. I mean, I know one of them that always springs to mind is John Hussman, who's got he's got clever models that look out 10 years and project the market return 10 years forward, and it's had a very, very remarkably accurate ability to forecast the movements of the market in the past. And he's also saying that basically, look out 10 years, you're not going to have made any money out of equities. You're going to have just had a big churn for 10 years, lots of volatility, which obviously you can probably make some money if you manage to capture the volatility and get on the right side of it. That's another question. But that by the end of the 10-year period, you probably have got your dividends, and that's maybe it. Don't expect too much in the way of capital growth. You were also quoted in a tweet recently, where was it last week or earlier this week even, where you reckon that bonds offer the big opportunity right now. So, I mean, I know you did allude to that a moment ago when you said that equity allocation is very high and fixed income allocation is historically low. I mean, treasuries typically are a safer place to hide if you believe you're going into a recessionary environment. I mean, can you just give a bit of color to that?
Yeah. I think so. So we can think about the long term and think about underexposure to fixed income, which is a reality. And so there's the opportunity for investors to reallocate from stocks to bonds if we get into this environment where stocks don't move higher. But we're also now, over the past couple of years, we've moved from this "there is no alternative" type of mantra because bond yields were so low. Well, now we've got across the curve, 4.5% to 5.5% yields in the US. Is it the same sort of bond bull market that you saw in the early 80s? I don't think so. But is it a place that you kind of hide out with some relative safety? I think probably. And so, investors might want to clip coupons from dividends. It might make more sense in this environment to just clip the coupons from the bonds themselves. Move away from the volatility of equity markets and you accept and embrace the fact that these interest rate hikes that we've seen now do actually give investors an opportunity to do something other than just try to ride out the storm in the equity market.
Yeah. I mean, the yields that you're able to earn on bonds, I mean, let's talk about 10-year treasuries, is higher than the dividend yield on the S&P 500 now, isn't it?
Yeah, it is. For a while, we actually saw the 1 year, the forward earnings yield on the S&P 500 was below the 1 year treasury yield. And so we've talked a lot through history about having an equity risk premium. For a while there, we actually had a bond risk premium, whatever that means.
Yeah.
But it's certainly the case that you're not getting paid for the risk that you're taking in equities in the same way that you have over the past decade. And for many investors, and I think this is probably the pivotal point here, is you have a generation of equity investors, particularly in the US, that think stocks go up and to the right. And when they stop doing that, it's a very short-lived pullback. They are not prepared for an environment where stocks don't go up and to the right over time, where you go up and then you go down, you go up and then you go down. So it's a psychological change and awareness that needs to take place on the part of US investors.
Yeah. No, you're right. I mean, and you're quite right. I mean, we had an entire generation, because I mean, rates have been in a declining trend for since 1981, and that's largely been a tailwind to equities over that time for on a bigger picture view. And I guess bear markets or that psychological shift doesn't happen overnight. It has to happen slowly. I suppose it grinds you down. You know, as you say, if you're suddenly not seeing the higher lows and higher highs all the time, but you're actually seeing lower lows and lower highs, and slowly but surely it kind of wears down the investor's confidence. But it takes time for that mind shift to change.
Yeah, I think so. And I think about consumer or investor sentiment, and we think about this move from optimism to pessimism. We need to remember that optimism and pessimism are very similar. The opposite of optimism isn't pessimism. The opposite of optimism is apathy. And so when investors become apathetic about equities and they sell them regardless of what they're doing, when they reallocate away from equity exposure, that's when you know you're starting to make some progress in terms of this secular cycle that I'm talking about. We haven't seen that. Equity exposure remains elevated. The AAI asset allocation survey every month has, talk about pessimism being rampant over the past year in this bear market in the US. Equity exposure is still above average. And so investors have not abandoned equities. It's still, you oscillate from optimism to pessimism, but that's still the game that's being played. Once we move to apathy and start to actually rotate away, then I think we can start to talk about some sort of secular progress.
Yeah. No, that's fair enough. I want to talk to you about market breadth as well, because that's also something that I've seen you alluding to a lot in your analysis. Basically saying that, the number of stocks below their 200-day moving average, for example, is still in the majority on the S&P 500. There's, I think when I look today, there's only, I think 39% of stocks are above their 200-day moving average. Obviously, this changes over time, but I mean, it's saying that more than half the stocks are still below their 200-day moving average, notwithstanding the fact that the S&P 500 itself is actually back above the 200-day moving average now. You also look at things like collective new lows and new highs. So, I mean, the breadth in the market, I guess, is not supportive of a bull market, would you say?
Very much so. So there's two ways to think about breadth right now. One way is to say breadth doesn't matter because the S&P 500's, weighting towards the top 7, 8, 10 stocks, whatever, is at or near its highest levels. And so, as far as those index go, those stocks go, that's where the index is going to go. And so you could minimize the breadth argument if you wanted to. I would take the opposite side and say breadth still matters, but we need to measure it correctly. A lot of people will come up with kind of random breadth indicators to support whatever view they want to get to. I think that's bad analysis. I think that's the type of thing that gives technical approaches a bad name, is when you pick and choose your approach so that it fits your prior conclusion. I have for a long time looked at net new highs. So new highs minus new lows on the NYSE and plus NASDAQ, 52-week new highs versus 52-week new lows. And as far as I can tell, it doesn't matter whether they've peaked or not. Net new highs have peaked or net new lows have peaked. What is pivotal is whether or not you are consistently getting more stocks making new lows or consistently getting more stocks making new highs. Right. Going back 30 plus years, all the net gains in the S&P 500 have come in an environment where you're seeing more stocks make net new highs than new lows. And that's not what we've seen on any sort of consistent basis since the peak, actually prior to the peak in January of 2022. And so that would,
And even now, I mean, so the market in this current pullback correction, call it, that we've had, nearly 10% on the S&P 500, it's been going on, 3.5 months or so. Even at that recent peak, was that also still not showing, not showing positive breadth at that stage either?
For the briefest of moments, yes. Okay. But then it quickly turned back to negative, and you go back to what we saw at the end of October, early November, that week there with tremendous short-term participation, that one of the best weeks for the S&P 500 in a year. I think small caps were up like 7.5% or something like that. Even in that week, we had one day in which more stocks were making new highs and new lows. And at the end of that, we quickly moved back to more stocks making new lows and new highs. And so, is it a simplistic approach? Yes. Has it worked? Yes. And so I don't want to overcomplicate things by changing time horizons, changing the universe, looking for peaks, things like, no, let's just use that dividing line. More stocks making new highs versus new lows, or more stocks making new lows versus new highs.
Yeah. Okay. So I had a chuckle at there's also, I think, a tweet that you put out earlier this week, said that the bulls are obsessing over Zweig like the bears obsess over Hindenburg. So just for context, the Zweig is the Zweig breadth model. And it gave a breadth thrust indicator earlier this week, which we can talk about in a moment. But these things kind of come around quite infrequently. And obviously all the bullish commentators are jumping on this and saying, well, this is now the signal that we're going to get this year-end rally. And then on the other hand, the Hindenburg omen is also one of these things. I mean, I also chuckled at it. A Hindenburg omen is a bearish indicator. And the Hindenburg omen has, it's forecast about 247 of the last 3 bear markets. So I guess one's got to take these things with a pinch of salt sometimes. But I mean, that's why breadth thrust indicator that did not place much reliance on that then at the moment.
So there's a couple. I have, over the course of my career, I have liked to use breadth thrust indicators as a signal of breadth. They have tended to be rare and they have tended to be important. Yeah. I have not used the Zweig breadth thrust indicator over the course of my career. So that's not one that I've looked at.
Okay.
But more broadly with breadth thrust indicators, they've become more frequent. And so if you have a signal that is notable for its infrequency, and then all of a sudden starts to become more frequent, then it suggests that something in the market dynamics may have changed. And so just stepping away from Zweig and even looking at the breadth thrust indicators that I have used in the past, I'm de-emphasizing them right now because we've gotten more and more signals, and they haven't been, from my perspective, as reliable as they were when they were relatively rare.
Okay. Can you just explain in basic terms how that breadth thrust indicator works, or one of the ones that you would look at in your work?
Yeah. So like one that I will use is I'll look at, it's a short-term one, the percentage of S&P 500 stocks making new 20-day highs. I think Jeff DeGraff, now at Renaissance Macro, he originally created it. I saw a version of it through Ned Davis research. So it looks at, you see a surge in the percentage of stocks making 20-day new highs. I think the signal is 55. If you get above 55%, then that's a thrust. The idea behind a breadth thrust is that you've kind of gotten really sold out. Everything's been really bad. And on a dime, you've pivoted. Everything's moving together all at once, moving higher. And that tends to produce momentum that persists.
Okay.
And so that's the idea. And then you can look at it over 3, 6, 12 months, and you can see these above average periods of return. When they're rare, they've been useful things to identify. The problem is they become less rare, and there's a lot of different breadth thrust indicators now. I mean, everyone has their own version of something that they've developed. And so I think the waters there have become muddied, and probably not as useful as they used to be. Okay.
All right. Interesting perspective there. All right. When it comes to managing risk, I mean, you've said you're not a trader, you're more of an investor. So I get that, but managing risk is still very important, irrespective of what approach you're taking, whether you be a short-term trader or a more longer-term investor. Do you have any specific rules or methodologies that you use to manage risk, which are unique to you? Or I mean, there's obviously some fairly generic ones out there, but is there anything specific that you look at?
Well, I mean, I try to develop models that tell me broadly whether or not the risk is to the upside or risk is to the downside. One of them is, I have a short term, I call it a fear of strength model. We've talked about the strength component of it already in terms of net new highs. If we're seeing net new highs, then we're seeing strength in the market, and so we can be long. The fear side of it is if we get a spike in the VIX and spike in volatility, then that also provides us a signal for being long. If we have neither fear nor strength, it doesn't make sense from a tactical perspective, to be in the market. And so that's one of the kind of tactical models that I rely on for risk control. From a more cyclical perspective, over time, I've developed a weight of the evidence model where I look at some macro indicators and then some technical indicators. And if it's tilted towards opportunity, then it makes sense to be a little longer. If we're tilted towards risk, it makes sense to be a little bit shorter, or rather not necessarily shorter, but less exposed to equities. So, a lot of times we think, and this is the non-trader in me probably coming out, that we need to be either long or short. My focus has generally been be long or a step to the sidelines and wait for better opportunities to emerge. So it's not necessarily long or short, rather long or sitting cash.
Okay, yeah, and I think that's important. A lot of people forget the fact that cash is a position, and
yes,
it's a nice position to be in when the markets are falling, and you've then kind of got a clearer head as well to put the money to work when the time is perhaps better. If you were let's just say, for example, I came to you right now and I said, blank slate, I've got $100,000 to invest. What? And I don't know if this is a fair question to ask you, because I know I'm putting you on the spot a bit here, but I mean, how would you allocate that from a weightings perspective? Equities versus bonds versus cash versus maybe, I don't know, commodities, currency. I don't know. What else would you do? Is that a fair question to ask? I know I'm putting you on the spot.
Yeah, I mean, coming from an environment where I dealt a lot with financial advisors who dealt with retail clients, the first thing to ask is, well, what is your base allocation?
Mm-hmm.
And so not knowing that, it's hard to know exactly what buckets to align to. I would say from a longer term perspective, whatever your starting point is for equities, you're probably underweighted. Whatever your starting point is for commodities, you probably overweighted. And so there's a couple ways to answer this, and which is to not actually answer your question, but to provide context for the reason why I won't answer the question.
Yeah.
One, I think we get stuck in a stocks versus bonds conversation way too often. When I first was starting out, probably early in your career, commodities were a viable asset class. It was talked about as being part of that asset allocation mix. Well, what happened over 20 years is commodities consistently underperformed to the point that they stopped getting talked about. And so the first part of the asset allocation discussion is making sure everybody every asset class that you need to be considering has a seat at the table. I guess I would say that we want to make sure that we are thinking about the right asset classes and making sure they have a seat at the table, and then we can decide how we're going to allocate them. So first, it's give stocks a seat at the table, give bonds a seat at the table, give commodities a seat at the table, give cash a seat at the table. Now, once we're there, I'd probably take a little away from equities, a little away from longer term bonds, again, whatever the starting allocation is. And right now, give a little bit more to cash, give a little bit more to commodities, with the idea that probably at some point in the not too distant future, we're probably going to be shifting from slightly shorter term bonds to probably slightly longer term bonds.
Right. Okay. All right. Excellent. That's great context. That's great. I always like to kind of end these podcasts off with a little bit of a lighter heart note to get to know the guests slightly outside of the hard stuff of markets. And I note that you're an urban farmer in your bio, which I found very interesting. It's something I've had sporadic interest in over the years, but tell me about that.
Yeah. So, I mean, it's something I do with my wife. We have we live in the city. We live in Milwaukee proper. So we've got a city lot, and we've slowly, as the kids have gotten a little bit older, taken more and more of the backyard away from lawn, away from a swing set, and more into raised beds, more into gardens. So, all summer long, we've shortened our supply chain for vegetables to our backyard. So it's been great. Do a lot of canning, a lot of pickling. add in some fruit production. We've got some grapevines, we've got some cherries and some pears and some apples. And so really this just something that grows is super enriching for the soul, I think. Especially given that, we've got jobs where we spend a lot of time looking at computer screens, looking at, blips up and blips down. It's nice to kind of get our hands dirty and actually see something that grows, and then you can eat it as a side benefit as well.
Yeah, I love it. I mean, I love seeing on your Twitter feed or your X feed the produce that you pop up on there from time to time. It's very enriching, and I like it. As you say, we do have jobs that are lead us to be in front of a screen a lot of the time. But it's actually nice to do something wholesome, and it's also a bit physical. Get out and about. So, I mean, as I say, I've had a sporadic interest in it over the years as well. I lived in South Africa for many years and moved to the UK 4 years ago. So when we lived in South Africa, we had a big property and we had a vegetable garden there. It's a little more difficult in the UK now with our small little properties, but you have kind of inspired me to actually go and get an allotment, because there is an allotment area out the back here, not far from us, which, and I think there might even be some free ones. Probably a good way to get away from the screens and actually do something wholesome.
Yeah, and I would say for a lot of people, it seems daunting to think, okay, well, I need all these raised beds, I need to have a full plot. Like, start with a container. Like, greens are super easy to grow in a container. Start with some herbs, start with some basil, start with some thyme. Something that you can grow those inside. So it's and so think about container gardening, and whatever spot you've got, find a nice, south facing brick wall. Here they have some of those in Britain, and just like let them grow and see what happens. And it's fun for me. Last winter we actually tried to keep stuff going all winter long. Became kind of onerous in the snows in Milwaukee to have stuff growing outside. So we're going to shut it down in the winter and then start again in the spring. But extending the growing season, bringing some stuff inside. It for me is a very soul satisfying pursuit at a time when the world or the market or the economy isn't always as perhaps soul satisfying as we'd like it to be.
Yeah, 100%. Brilliant. Well, I love it. Well, Willie, it's been a pleasure chatting to you. Thanks for your time. I just want to ask you one last thing. I mean, where can viewers and listeners to this podcast access your work? Obviously, your firm is HiMount Research, but where's the best place for them to get in touch with you?
Yeah, so a couple ways. You on Twitter or X at Willie Delwiche. You can also go to HiMountResearch.com, HiMount research.com, and you can fill out like an info, want more info form there, and to reach out. I'm on Substack, so HiMountResearch.substack.com as well. Or check me out on LinkedIn. I think people still connect on LinkedIn. So any of those areas are great ways to get a hold of me. Or if someone happens to be in Milwaukee, invite me out for coffee, invite me out for a beer. I'm open to that as well.
Yeah, well, if I'm ever there, I'll definitely take you up on that.
Sounds good.
Well, thanks, Willie. I really appreciate your time. It's been great speaking to you. I've looked forward to this very much, and it's great to get your insights. Thank you very much.
Yeah, thanks for having me on. It was a great conversation.
Cool. Thanks, man. Thanks for joining us for today's episode of Talking with Traders, brought to you by IG, a world-leading CFD provider. We really are privileged to have such a leader in the field of online trading involved in this series. Please follow us on Facebook and engage with us there. And a reminder to make sure you subscribe to this series by clicking on the subscribe button on your favorite podcast app. If you've enjoyed this podcast, we'd also appreciate if you'd leave a review on the app too. Till next time.